Well, we've certainly seen a deterioration in household finances in the US. The question becomes now, what do they prioritize and what are they willing to pay? And is the mortgage something they feel that they can get away with not paying for some time? I think the banks have sort of signaled that they would be quite lenient in terms of forbearances with retail investors, retail customers, I mean, in terms of their mortgages and not foreclose on them too quickly. And perhaps that was encouraging to people to just sort of skip their mortgage payments for a couple of months in the hopes of catching them up. But I don't think things look as bad as we thought they might be. So if you look at the US job numbers recently, retail sales and things of that sort, it's looking like the US economy is bouncing back quite sharply. So these ideas that people are just going to completely stop paying their rent and completely stop paying their mortgages seem to have been a bit overblown. I think they were right to be very cautious in their loss provisions, but it looks like they went perhaps a bit too far. So I agree with you. It's important to keep an eye of caution on the mortgage repayment rates and delinquency rates, but it doesn't look quite as bleak as we thought it would be just a couple of weeks ago.
But Octavio, good morning, sir. Look, regardless of what's going on in the underlying economy and rents and mortgages, what have you, the fact is there is a sense of realism in US banks that we just don't see in European banks. When we saw in the first quarter, Jamie Dimon's JP Morgan write down, they make credit provisions of $8.3 billion, which is about 6 times what they've done previously as well. They did something ahead of the curve that European banks wouldn't do for years and won't do for years, because we know how it went in the GFC as well. Isn't there something systemically wrong on the regulations and indeed the way that the banks in Europe treat bad debts and defaulting loans and what have you, compared with what the Americans do? And as such, the American premium of their banks compared to Europe will be maintained.
Well, I think they might well be maintained. I would say about the European banks, I think, at least looking at the retail banking side of things, I think the European banks have been very, very cautious in terms of their lending over the course of the past few years. So I think in general, you'll see that the amount of capital that European banks have reserved is quite sound, and they're in a fairly strong liquidity position there. The US economy is, of course, somewhat different in the sense that once you lose your job, you're basically on unemployment benefits that will allow you to eat, but not much more. In Europe, we're substantially more generous than that in general in most European countries. So the odds that a European consumer loses their job and then is not able to repay their debt is significantly lower in Europe, at least in the medium term for a couple of years, than it would be in the US. So I don't think the European banks are way off the mark in terms of the loss provisions they set aside. And we did see some banks, such as HSBC, set aside quite a bit of money in terms of loss provisions there as well. So I'm not sure I agree with you entirely that the European banks are sort of cooking the books a bit here or being too optimistic about the future. I think many of them are quite pessimistic. But remember, going into this, the European banks had a very strong capital position, had pretty sound balance sheets, and were prepared to weather quite a storm. Maybe not a storm quite as bad as this, but certainly they were ready for a downturn should that happen in their credit portfolios.